Hello, friends. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 11th of April, a week that we'll remember for a long time. There were lots and ups and downs, a huge down move at the beginning of the week, and then surprising reversion back to where we started from, and extreme volatility in the markets. Markets suggesting that recessionary trends are here to stay. At least the bond yields are suggesting that. And lots to unpack in this video. Please watch this video till the end. This week, from our research desk, we released all these fantastic pieces on Bhao Bhagwan Che, how the Japanese are handling the Trump trade, what happened to gold in 1971, is the strategy beating the benchmark or not? US markets are taking the world down. How gold is breaking correlations? Are we in a commodity super cycle? What are the dynamics of the gold mining business, and much more? You can see all this on the Weekend Investing app. You can also see many of these stories in the daily newsletter that we send out, or on the YouTube channels that we have. Disclaimer: please read this fully. This is very important that you understand and fully read the disclaimers. Do subscribe to the channel if you wish to send some love our way, and also click on the bell notification. Nifty, the daily chart, you can see it was a 4 day week. So we started the week with a huge gap down from nearly 22,850 to 21,780 or somewhere near that. 1,000 point gap down, and it's taken 4 sessions to almost come back to the same point. So net we haven't lost anything much on the Nifty this week, 0.3% down. Nifty index on a weekly chart, you can see here, it did make a new recent low, but it did not yet breach the June 2024 bottom, which is good news. We have been maintaining for a long while that this level is going to be one very key level, which is unlikely to break unless really the world breaks apart. We are down from 26,000 plus to nearly 21,800 at the start of the week, and by the end of the week we were at 22,800. S&P 500, which also was collapsing very very rapidly, went down to below 5,000, below the April lows, but recovered smartly. Still not out of the woods, but 5.7% gain for the week is more than welcome. Gold is up 7.4% just in this week. I have been in the gold market as a investor and as a observer for decades now, and I have not seen a 8% kind of a move happening in a week easily. So gold is suggesting that the current monetary system is getting restructured, the contours of which we will not know until it happens. It also means to me that the flight to safety is the prime concern for most investors right now. So people who are coming out of US equity, out of US dollar, could be headed towards gold and not as much towards US treasuries, which was the usual route. And this kind of a gold move, where in just look at where we've come from. Just last uh, April, we are now in April, and last April we were at 65,000, and from there we've already at 95,000. So that's a crazy 40-50% kind of a move in 1 year, and that is suggestive that things are not hunky dory all over the world. Dollar index is rapidly falling, down 3% this week at a very crucial support point. Uh, to this extent, Trump's target is getting met, that dollar should be weakened versus other currencies. He is achieving that target, but at what cost? The cost is the US markets coming off, the confidence in the dollar system going off, the confidence in America as a trading partner coming off, and your yields not coming off. That is the biggest uh, you know uh, joker in the pack. Benchmark indices, uh, all down, but mildly this week. Small caps actually slightly up. So nothing really to talk about on the indices. They are doing absolutely flat this week, which is very good news for a volatile week like this. In terms of sectoral overviews, we had a fantastic gainer amongst FMCG this week, which was up 3.6%. And metals and real estate really bore the brunt this week at minus 4% and minus 2.9%. IT also down by 2.3%. So IT now, if I see, let's say, 3-month chart, is down 26.6%. So IT services stocks are really taking it on the chin. Real estate is down 18%, and autos are down 10.7%. For the year gone by, you still have energy down 19%. IT is still not bad for the last 1 year at minus 7. PSU banks are minus 15. Real estate is minus 17. So, and capital market has done very well in the last 1 year, although over 3 months, capital market is also down 8.8%. So, nevertheless, but as we always see that over, let's say, 3 year period, almost all sectors have done decently well, media aside. Over 5 year period, everything has done well, double digit gains on on many of the high double digit gains on many of the sectors. So defense has been amazing for 3 years and 5 year view, but in the last 1 year also, defense, capital markets, financial services, these stocks have done well. So sectors will keep rotating, and your strategy should rotate with the sectors. That is the idea. The sectoral momentum score for different sectors is calculated here basis different frequencies. So 1 week, 1 month, 3 months, 6 months, 1 year. You can see that some sectors have been perennially perennially green, uh, and tourism is one of them. Financial services has recently lost some steam. Defense has been up there practically. Capital market had dipped in the middle but has come back. FMCG, which was reeling, has come back very strongly. PSEs, which were down in the longer term, are up now in the very short term. And what is reversed? PSU banks have recently gone down. You can see that IT and real estate have consistently been the last rankers, and hence, you have some sectors that have been consistently underperforming, and some sectors that are coming up. In the weekly advance decline ratio, you can see that 72% declines in Nifty, 78 in Nifty. In fact, all of them are nearly 72 to 78%, 79%. So one third of the market is going up, two-third of the markets is going down in this last 1 week. Percentage of stocks outperforming, Nifty still has a third of its stock which is outperforming itself, the benchmark. Others are much lower. Over a 3 month period, you still have Nifty doing much better. Over the last 1 year period, you have Nifty doing much better. So across the board, you can see that Nifty has been that space, or we can say mostly large cap space, where more stocks are outperforming the benchmark, and the benchmark itself is not performing so badly. In the market cap segment wise drop from 52-week high, here the pain is very obvious. uh, in the Nifty space, you can see 10 to 30% down, you have 60% stocks. In the Nifty next 50 space, you have 20 to 40% drop as the major segment. In the mid cap and small cap space, you can see that it is distributed over 10 to 50%. And in small and mid micro cap, you can see significant part is also beyond 50% drop from 52-week high. So the pain is very linearly distributed, least pain in large caps and the most pain in micro caps. Let's see some trends. So percentage of CNX 500 stocks above the 200 DMA. So only 19% stocks are above the 200 DMA, which is very poor. And 50 DMA is about 41%, which is poor, but it's better than being at 7%, which was there middle of February or end of, or towards beginning of March. So things are gradually thawing. You can see that the trend is sort of changing as we go along. In terms of sectoral trends, you can see that in private banks, 90% of private banks are above 50 DMA, which is very good news. FMCG is now coming back up, 80% stocks are above 50 DMA. Energy stocks are up, financial services are up, manufacturing is up. So many of these sectors are looking up. Better to see also 200 DMA, where private banks, energy, manufacturing, PSU banks, financial services, more than 50% of stocks in these sectors are above 200 DMA, which is very good. On the flip side, the entire CNX 500 universe only has 19% stocks above SMA. So all these sectors are actually outperforming the CNX 500 from this perspective. Public sector enterprise stocks, IT stocks have very poor, number of stocks above the 200 TMA. In terms of the FII DI stats, FIIs continue to sell almost 2 to 5,000 crores on a daily basis. That trend is not changing, and DII is continuing to buy. Big buy on 7th of April, and this week has been good, 3,000 plus crores. So the domestic institutions, the domestic investors are not backing off, which is very good news. And overall, for the last 1 month, the cumulative activity, we've seen 55,000 crores of DII money coming in, while 23,000 crores going out. So we are net very much in positive zone on a net basis for the institutional money. That's all for this week's weekly report. Thank you so much. Do let us know your feedback on these reports, and of course, do subscribe to the channel and do like these videos, and of course, share them with your friends and family. Thank you. Bye.